My name is Jean Oy. I'm the director of the China program at Shorenstein A Park. And today I want to welcome you to our continuing series on important aspects of China. Today's talk is also something, the topic is something that you probably have seen a lot of reports about. We're talking about banks, we're talking about debt, we're talking about defaults, bank runs, all this very important, it's technical financial stuff, but it's very important politically as well. And I think that this topic also goes along with, and as our speaker will tell us, is actually also related to the collapse of the real estate market as well as the housing market. And to talk about this topic, both in depth but also with fresh insights, I am just delighted to welcome back a Stanford product. And I have to say, my own advisee from the political science department, Adam Liu. He got his Ph.D. in political science in 2018. He wrote a superb dissertation on China's local state banks. This is something that he is, I think, at this point, I think the world's leading expert. This dissertation won the award given out by BRICS for the best dissertation on economic development. He's currently taking that great book, a dissertation, and turning it into a book about how central local politics has really driven the formation, expansion, and operation of what he calls a state-owned market in China's banking sector. He's also doing that while also being an assistant professor at the Lee Kuan Yew School of Public Policy at the National University of Singapore. Adam, welcome back, and we look forward to hearing your insights on these very important questions. Adam.
Thank you very much, Jean, for that very, very kind and generous introduction. It's great to be back home at Stanford. So today I want to be talking about China's banking system. I want to be starting to say a few words about, it seems to be the case that, China's banking system is really at the heart of a lot of, the problems that Chinese leaders are facing today. Last year we had the Evergrande home buyer protest. Earlier this year, we had the depositor protest in Henan province. And at the same time, it seems to be the case that the Chinese government is still trying to, strangle some private firms and even dismantling some of them, as what happened to the Tomorrow Group. And at the same time, local governments in China seems to be in trouble because they are facing both rising debt as well as decreasing revenue in the country. So why is this happening? Why are all of these problems really festering at the same time? Some people point to, troubled relations, with the outside world as one potential explanation, but most others believe that it's really President Xi, the person and his policies. And still others believe that this is just natural outcome. All fast-growing economies slow down at some point. But I think all of these are just catalysts of the current problems. The root problem really lies in the kind of market system that that the Communist Party has built or has ended up with in the reform era. It's a system of what I call state-owned market system. And I see it as a system where the visible hand of the state seeks to both create and hold the invisible hand of the market. And in this system, competitive and administrative allocations both exist, profits and politics both matter, and party discipline and market discipline both dictate. And I think nowhere is such a market system best at work in the country's gigantic banking industry. And specifically, I'm going to argue that the state-engineered bank proliferation and market competition really lies at the heart of China's past economic success, but more importantly, its current economic challenges. And this talk explains why. But before we get to that, I wish to just give you a sense of what do I mean by bank proliferation in China. So back in 1993, this is a map of China from 1993, okay? These little red dots that you see are bank headquarters. So I'm not showing you branches because that's going to be all over the place. Back then, China had 14 banks, and most of them are clustered in Beijing, right? The bank headquarters. So that's why we don't see 14 on the map, because they are on top of each other. But now, almost every single locality in China has its own bank headquarters, and in some places, multiple. So this is the sort of bank proliferation I'm referring to. And I call these new banks that appeared in China local state banks, because all of them were actually organized by local governments at some point over the past 30 years. So it's really a misnomer to just call these banks regional banks, small banks, medium-sized banks, and so on and so forth, as what is commonly done in the media and in much of the academic writing, because these names really miss the institutional souls of these banks. And I would say that these local state banks have been the wildest animals in the Chinese economy in the past 30 years. And understanding the entry, expansion, and now in some cases, extinction of some of these banks are really probably the best prism through which to understand how the party state is building market within its own political institutions. So let me just give you one example before I go to the gist of the talk. I'm pretty sure that you've all heard of the Baoshan Bank, because it was in the international headlines all over the world 2 years ago. On the vertical axis, we see the number of branches. So clearly, there are three phases to the development of this one particular local state bank: entry, boom, and bust. And today, we're going to come back to this picture again and again to make sense of each stages of the development of the bank, and discuss what does this tell us about the general political economy of China at each particular moment in history. So for the rest of the talk, I'm going to try to discuss, why did this happen? Why did bank proliferation happen in China? Why does the central government allow for this? Because this doesn't make any sense. A lot of authoritarian countries doesn't like this, because this would essentially mean chipping away central control of financial resources. Number two, how did this happen? Because when the local state banks entered the market, the Chinese banking system was already dominated by the four giant central state banks: Bank of China, Agricultural Bank of China, so on and so forth. So how did the process unfold? Three, what have been the economic consequences of this development? And finally, I'm going to conclude with some final thoughts about Chinese banking system and the kind of market economy that the Communist Party is trying to build in the reform era. So why did this happen? A lot of people think that there's no puzzle. They see banking proliferation in China as a natural outcome of financial development. You know, as the economy opens up, the private sector, individuals will need more financial support, so there will be more banks. But that's the wrong story in the Chinese context. Helping private firms out or individuals out was hardly what Beijing had in mind when it allowed for the rise of local state banks. It has a lot to do with a specific central local grant bargain in the mid-1990s. By the way, this is a term coined by Professor Jinoy and I, and our co-author Zhang Yi, in our recent new paper about China's local government debt. But the Grand Bargain was also very much related. It was at the core of understanding bank proliferation in China. Basically, in short, Beijing used bank licenses in the mid-1990s as a bargaining chip to solicit local support for a set of centralizing reforms, and fiscal recentralization being the most critical. But then the question is, why does Beijing have to use bank licenses to solicit local support? Why do local governments in China need to be pampered and cajoled because Beijing can just, do whatever it wants to do? It has to do with this graph. What you see here is that the dashed line is the local share of the country's revenue. And the solid line here is the local expenditure share. And as you can see, since the mid-1980s, local share of revenue kept rising to the point where by 1993, localities had 78% of the country's revenue. So that means Beijing was only getting 22%. This happened not by accident, but by design. In the Maoist period, localities had to submit all of their revenue to upper level governments and waiting for upper budgetary allocations. Yet things changed completely in the Deng era. After submitting certain amount of taxes to the center, localities got to keep the rest. And more importantly, they got to keep what was known as extra budgetary revenues that need not be shared with upper level governments. So this provided a lot of incentive to localities to grow their local economies and maximize their revenue tirelessly and ingeniously. But over time, a lot of people in China worried that this could lead China into a Yugoslavia-style crisis where physical decentralization could lead to political disintegration. So in 1993, China's Vice Premier Zhu Rongji, the country's economic czar, pointed to this, and he was like, we got to do something about this. We had to re-centralize to make sure that Beijing, the central government, has sufficient revenue. And he did very successfully do it. In one fell swoop, in 1994, Beijing re-centralized over the country's fiscal system. You can see here, the local share of revenue dropped from 78% right to 44%. But the important message to remember is that even as a powerful central authoritarian government, Beijing didn't do it through a simple central directive. In fact, the center negotiated really hard with localities. In 1993, Zhu Rongji led a team of 70 central bureaucrats. He traveled to 17 provinces in 70 days, basically to sell his fiscal decentralization plan to the localities. And he made quite a bit of concessions, offers to the localities. He promised tax returns, fiscal transfers. He promised localities they could have maximum spending autonomy after fiscal decentralization, and localities could keep selling land to get their land revenue. But the most important part of the concession package, which was rarely discussed, is that he allowed local governments to enter banking. And he specifically said that, after fiscal decentralization, local governments could have their own banks, and local party organizations would be in charge of these banks. And you can find these quotes in Zhu Rongji's very great memoirs. So right after fiscal recentralization in 1994, we see, the dramatic expansion of banking institutions in China. The solid line here indicates the number of the sizable local state banks in China. So clearly, 1994 is a watershed moment. As a result, the Big Four's asset share continues to drop, as you can see from the bar charts. Let's come back to the Baoshan Bank. The Baoshan Bank started in 1998. So you must be wondering, why did the bank start with 51 branches right away? This is not a data measurement problem, because when he negotiated with the localities, Zhu Yunji actually promised that the center will transfer some of the urban cooperative unions that were under the central control to local governments as their starting assets. So basically, the center even assisted localities in the process of creating their own banks. That's why we see, in the case of Baoshan, they started with 51 branches right away. So how did this happen? So basically, once they enter the market, how did the local state banks grow as fast and as aggressively as they could? I'm going to mention a few things. Bank entrepreneurialism, local state corporatism, and this is, again, a term coined by Professor Jinoi, and political competition across localities in China. So basically, we're talking about this part of the story now, referring back to the case of Baoshan. How did the bank grow so fast since the mid-2000s? All these local state banks started with extraordinarily, I would say, entrepreneurial bosses, because the founders of these banks are usually Big Four bankers or central, folks who work in the central bank who chose to leave the old system to blaze a new trail. I've interviewed a lot of them, and we can come back and discuss their characters later on. Second, all of these local state banks faced, I would say, an existential challenge right away, because when they entered the market, the Big Four was already dominant. They had sweeping presence across the country, especially they were dominant in the deposit market. So they had to compete as fiercely as they could in order to survive and thrive. But more importantly, all these local state banks had exceptional support from local governments, right? Most local governments use their fiscal revenue to support these banks, especially in their formative years. This is the local state corporatism part. They organized their SOEs and work units to make deposits in the banks, to set up their payrolls with the banks in order to boost the development of the banks. Local governments have also engaged in what I call constructive extractions from other parts of the local economy to support the banks. Constructive in a sense, let me give you two examples. They've been persuading some of the wealthier local private firms to borrow from the banks when they don't necessarily need to, so that the balance sheet of the banks could keep growing. And they've even went around and asked for religious institutions within locality to put their donations in the local state banks in order to support their development in the early years. So with such strong local support, the local state banks have been very aggressive in expanding their markets. They've engaged in all sorts of what I call market campaigns to expand. For example, sending their employees to all corners of the locality to attract depositors, selling their products and services on weekends. Of course, the local state banks have also been engaging in all sorts of arbitrage to grow. For example, you must have heard of the so-called village and township banks in China. These are the problematic ones that caused the crisis in Henan province earlier this year. We can come back to this point later on during Q&A. But to be sure, most of these banks were actually created by city level or province level local state banks. So they were basically the subsidiaries of the city level local state banks. Because back in the Kuan era, Beijing was very much focused on, rural development. So it was trying to push more financial institutions to be created in the rural areas. So many local state banks in the cities seized the opportunities and applied for additional licensees from the center, promising that they were going to set up all these village township banks in the villages and townships. But in many instances, they actually didn't. Once they got the licenses, they plugged these new village township banks into urban cores as additional branches to attract even more deposits from urban residents. You might think that, okay, once they enter the market, once local governments have their own banks, their end game must be becoming local monopolists, right? They want to monopolize local financial resources. They wish to squeeze out the big four. No, that's not the case. Local governments, neither do they have the capacity nor incentive to become local banking monopolists. In fact, when we look at, this is a map of the city of Baotou, where the headquarters of Baoshan Bank was located. And on the map, different colors represent different banks. So we don't just see a 4+1, right? 4 large state banks plus 1 local state bank. We see multiple colors because the incentive for local governments has always been to aggrandize, not monopolize local banking resources. Why? Because local officials are basically roving bandits. They don't get to stay in their locality forever. They get to stay in one city for 3 to 5 years, and even shorter than that. So there's no way for them to monopolize, to become banking monopolists within a short period of time. And also, the big four banks are still the most, trustworthy in the eyes, most trustworthy financial institutions in China in the eyes of most Chinese. So there's no way that local state banks can completely squeeze out the big guys. But again, local officials wish to maximize their financial resources within their short tenure. So that's why they've maintained what I call an open door policy. They've actually been very active in inviting banks from outside their jurisdictions to enter their local market. Because when a bank from the outside enters, most of the time, they have to sign strategic partnerships with the local government. That is to say, once the bank enters the locality, it has to make certain amount of loans to specified sectors or firms that the local government deems necessary. So basically, they have to pay an entry premium. So this is just a case of a local government signing a so-called strategic partnership with another local state bank from outside their jurisdictions. Another institutional driver of market transformation in China is basically the performance evaluation system within the communist nomenclatura system. So basically, all local officials need to be evaluated. And in the recent past, I would say over the past 10 or so years, local financial development has become a big part of local cadre evaluation. what does local financial development mean? Specifically, it means how much of the local market share in both the deposit market and the lending market, how much of the local market is being captured by local financial institutions that are not the big four, right? So this provided additional incentives for local governments to grow their local state banks, but also invite other smaller institutions to enter their jurisdiction. For example, in Shandong province, when Guo Shuqing, who's now the top banking regulator in China, when he was the province governor of Shandong province, he was very enthusiastic about putting up these local smaller financial institutions to boost local financial development. So local financial development was a big part of Shandong province culture evaluation institution. But ironically, later on, when he became the top regulator, he had to manage these smaller financial institutions. So consequences. What has happened since then? Once the local state banks entered, once they've trying to grow their markets as aggressively as they could, the big four's market share, asset share, has dwindled from almost 100% in the early 1980s to now just about 25%. This is a big revolution. This is a big, I would say, a quiet revolution within the still state-controlled banking system in China. Second, of course, with the rise of local state banks, there's been intense competition in the Chinese banking industry. But at the same time, private and foreign banks are still playing a very negligible role in the system. So the whole market remains state-owned. So just to visualize the change a little bit, from 1986 to 2001 to 2009 to 2019, the big four, by 2019, the big four is only dominant in Tibet. That means that it's only in Tibet that the big four is controlling more than 50% of the local branches. And that's a pretty good proxy for the banking assets that they control. For the rest of the country, the big four controls roughly around 25 to 30% of the local branches. The rest are all local state banks. So that's why I say this has been a quiet revolution inside the Chinese state-controlled banking system that people rarely talk about. As a result, very naturally, local state banks are now a crucial pillar of the local economy. Before President Xi took power, they have been a big driver of local private sector development. In 2004, Nick Lardy argued that it was wrong to argue that the private sector was receiving far less bank credit from the banking system. In fact, in 2010, 2011, 2012, the private sector in China was actually getting more bank lendings than the state sector did. And he suggested that could be the result of market diversification and increasing competition in the banking system. And I tested it in my own work. It is indeed the case that as local state bank expansion is positively correlated with local private sector investment, whereas greater concentration of the big four banks, as shown here, is in fact negatively correlated with local private sector investment. Also, the local state banks, unsurprisingly, have been absolutely critical to the so-called local government financing vehicles. Simply put, these are the local SOEs created by local governments to allow local governments to borrow from the banking system, because by law, they cannot do that. So we can see that the expansion of the local state banks is also very much positively correlated, highly correlated with the accumulation of local government debt. This is data from 2013. And in recent years, as the government is trying to deal with the debt issue, they've been starting this, debt swap program because, many local government financing vehicles have been issuing bonds to raise money for local infrastructure. And a lot of these bonds were actually bought, unsurprisingly, again, by local government, local state banks. How do we know? Because through this debt swap program, what the government is essentially trying to do is to issue new municipal government bonds to replace the LGFV, the local government financing vehicle bonds, with, basically because the new municipal bonds have lower interest and longer payback period, so that they can, provide localities with a bit of a breathing room. So the point is that the more a bank actually lent to the local government financing vehicles before, the more of these new municipal bonds that they should be holding at the moment. And that is indeed what we see in the data, right? This shows you that in 2020, the local state banks in cities and in rural areas, they hold 94% of the municipal government bonds. So that means, by inference, they've been, lending a lot to these local government financing vehicles vis-a-vis the big four banks. And of course, this has a lot to do with credit expansion during the global financial crisis. And coming back to the Baoshan Bank case, this is the period, right, since 2009, this is the period when these local state banks grew the fastest. Moreover, the local state banks have also been very much critical to the development of the local real estate sector. Before President Xi started reining in investment in the property sector, the local state banks have been pouring money into it. And it was the rational thing to do because it was the whole sector was booming, so it was profitable. But from the perspective of the local governments, it was also politically important to support the local real estate sector, so that the local real estate firms could keep purchasing land from local governments, right? So basically, these local state banks, you can see them as the conduits that transfer banking resources to local coffers. So that's why we see a very clear positive correlation between the size of the local state banks and local real estate sector investment. This is province level data from 2000 to 2018. Moreover, not only had the local state banks been pouring money into the real estate sector, they have been also inviting a lot of the local real estate firms and also some of the big national ones to become their shareholders, further enmeshing the two sectors. For example, Evergrande, right? 3 years before, I think 5 years before its 2021 crisis, Evergrande purchased, for example, 17% of the shares from Shengjing Bank, a local state bank from Liaoning province, becoming its biggest shareholder. And in 2019, after the collapse of the Baoshan Bank, all local governments in China hurried to audit their own local state banks to make sure that they're okay. And it was during that time that the city government of Shenyang invited, the key term is invited, Evergrande to increase its shares in Shengjing Bank to 36%. And in return, the company received new projects from the local governments and had more of his own people sitting on the bank's board. This is the local government officials welcoming Xu Jiayin, the head of Evergrande. You must be wondering, where were the regulators? How come this dramatic expansion of the local state banks was not regulated? Because we can see this really as the legacy of the grand bargain that I started to talk with. Because the central government was basically promised that they would not meddle with local finance. They wouldn't care about how local governments raise money, spend their money. All the central government cared about was how much money the center was getting. So when I interviewed financial regulators, they told me that from their perspective, there are really two eras of financial regulation in China. During the Kuan era, it was in their own words, it was the era of great development. Nobody was, paying attention to regulation. Nobody was being serious about regulation, and nobody even wanted to regulate. So that's why we see this is data from the CBRC, the Central Banking and Insurance Regulation Commission. From the official statistics, we see that in the Kuan era, these are warnings and punishments issued to banks by year. In the Kuan era, there were very few such warnings and punishments, considering how many banks were there in China. And since 2015, and very specifically, June 15th, 2015, President Xi Jinping's birthday, also the day of the stock market crisis in China, China entered a new era of strengthening financial regulation and preempting local financial crises. That's why we see this spike of the number of warnings and punishments issued to banks. So this is also when this regulatory ratcheting up of the regulatory pressure reached its peak in 2020. This is also the time when Baoshan Bank collapsed during this high regulatory pressure. So when we look at individual bank level data, we see the same story. So basically, after 2015, every bank is getting these notices, punishment and warnings every year. These darker triangles, rectangles, indicates for that bank that year, there is at least one warning or punishment issued to the bank. So these are the so-called joint stock banks in China, and many of them are actually still, local state banks. For example, Guangfa Bank is just is controlled by the province government of Guangdong, and these are the big 4 or 5 banks. But the real interesting story is the local state banks. Before 2015, they were basically left untouched. For many local state banks, they received 0 warning, 0 punishment for more than 15 years. And a lot of these banks have been engaging in a lot of practices that go against central regulation, but still, they were left untouched. Okay? But this high regulatory pressure, can China sustain this? Probably not. Because when the economy is slowing down, during COVID, when China is still sticking to its zero COVID policy, we see in 2021, they started to backtrack, okay? And the number of warnings and punishments, dropped back to below to 3,000, from 5,000 to 3,000. So what does this tell us about China's banking market overall, and the kind of market system that the party is residing over? Again, let me refer back to Nick Lardy, one of the most seasoned observers of Chinese banking system. He wrote this book, Markets Over Mao, back in 2014, in which he argued that, China's banking system has transformed fundamentally. And as a result, the local private sector is getting a lot of lending and support. And basically, the big four is no longer dominating the market. Everything was fine. China is moving very resolutely to market-oriented reforms. And just a few years later, he wrote another book, The State Strikes Back, in which he argues that, oh no, in fact, Mao is still over markets in China. The state is still there. And, the government, the banking sector is still lending overwhelmingly to the state sector now. So which Lardy is correct? I would say both. And I don't think the whole thing was necessarily caused by President Xi alone, because I think a lot of China observers, including Prof. Lardy himself, really missed the fact that the whole process of market development in China was very much engineered by the state, and most of the actors in the system remain either directly state-owned or state-controlled, even including some of the so-called private banks, such as Minsheng, because their directors are still appointed by the organizational department rather than being chosen by the biggest shareholders. Remember, Deng Xiaoping said at the very outset of reform, market is just a tool of the state, just like planning is. So markets is never the goal of reform. It's always being treated as the tool of the Communist Party. So in this market, basically incentive is not only organized around profits and market shares, but of course also organized around other objectives of the state, both central and local. And as the state objectives change, the dynamism and the dynamics of markets also change. So in such a market, we will, I'm willing to make this prediction that we will never be able to see, as long as the Communist Party is in power, we will never see massive entry of genuine private and foreign banks, nor will we see massive waves of bank failure. In this market, there's no creative destruction, but only creative reorganization. I'll stop here.
I'd like to pose a number of questions.
Yes, please.
First, well, there's so many.
This is like going back to the office hours, That's cool.
Well, not quite, but any case, so you mentioned the link between the local state banks and the local government financing vehicles. And, I think that most in the audience know that local government debt in China has been just spiraling out of control. And particularly with the collapse of the real estate market and the government as a way of trying to prop up local government revenues, local government economy, they're actually asking the local government financing vehicles to go in and take up the slack in buying land. Now, what I want to know is what has happened to these local state banks? Because, there are the reports that, the amount of debt they have is this leading to default? You say you ended by saying that, well, you don't think there's going to be a crisis. So, given how much debt is, do you think the state, first let me ask, well, can the state still handle it in terms of preventing large scale defaults?
Yes, I mean, I can't say
Well,
that.
obviously, we won't know for sure, but
Yeah, I can't be no, I can't know this for sure, but um, yes, because I think a lot of local governments, especially as I said, after 2019, they've been preparing for um, something like this early on, trying to basically diversify their shareholders, um, but because the economy is slowing down, my prediction is that the big four banks will probably come in and save a lot of these smaller ones. As to what happened to Baoshan Bank, to Jinzhou Bank, Shengjing Bank, Hengsheng Bank, all of these. So basically, when a crisis is impending, what they do is they will set up a committee consisted of people from both the Central Regulation, Banking Regulation Commission, as well as the provincial governments and city governments. The local fiscal bureau, everything will be sitting on the same committee and trying to figure out how to deal with the problematic banks. Usually, in some cases, I think in the case of Jinzhou Bank, another local state bank in Liaoning province, the bank was basically taken over by the central bank itself. So, basically, there will be all these problematic ones as long as central financial situation is still okay. I think, they will make sure that systematic local financial crisis won't happen. And this is something they've been talking about since 2016, right after the 2015 the stock market crisis. But this goes back to the question, they're really in this catch-22 dilemma. So basically, how far can they go in bailing out these banks while strengthening regulation all at the same time? So they're really trying to juggle. And we can say that China is sort of trapped in its own model of development. So what do you do with these local state banks? Because they've become so important in supporting the local economy, but you can't let them go crazy anymore. You have to regulate them. Let me give you two, I should say this during the presentation, but since we are running out of time, I think China can still do a lot of things to fix the problem. There were a lot of institutional weaknesses in the regulatory regime. For one thing, the local state banks have so much trouble because their presidents, their leadership is not subject to rotation. So basically, once you are the president of Shengjing Bank or Baoshan Bank, you can stay there for as long as you want to. So basically, this gives them a lot of incentive to, basically collude with local officials, the real sector. So unlike the big four banks, all the big four managers, they were subject to routine rotations. For example, the head of Bank of China in Liaoning province has to be rotated, right, every 3-5 years. But this institution wasn't applied to the local state banks. And I think that's a big problem.
So,
yes. Yeah,
no, I was just going to sort of interrupt and say, because I think that the audience may also be very interested in seeing your insights as to how is it then that you could have a situation that occurred this summer where in Henan you have these really small local banks that refuse to let people take out their money.
Yes. this is another thing I should be covering in the talk, but I just don't have time. Um, this is another institutional weakness in the regulation regime that China can fix, right? So basically, this is something that Beijing can try to, a problem that Beijing can try to solve, because these small village township banks, the problematic ones that led Henan into this crisis, were again created by another bigger local state bank. So they were basically the subsidiaries.
Uh-huh.
The problem is that these village and township banks, okay, first of all, there are two problems. They've been using all sorts of technology, cell phone, fintech technology, they've been collaborating with a lot of internet companies, try to, basically raise deposits from other parts of the country. And so that's something that's been fixed, I think, because the center just, came out saying that, no, you cannot attract deposits from other parts of the country if you don't have a physical branch in that locality, right? You can only attract deposits as long as you have a physical branch. So you can't use these cell phones to attract deposits from other parts of the country. But the biggest problem, the biggest regulatory weakness before that really led to this crisis is that these village township banks, they were basically invisible to the central regulators in the sense that they are not directly connected to the central clearing and settlement system. And every transaction of the village township banks are recorded in their parent city state bank. So basically, once these depositors, made a lot of deposits in the township village bank, it is the city bank that issued a notice or a receipt to the depositors. Okay, we received your money, without letting the central regulators know. So basically, the central regulators had little knowledge or no knowledge as to what was going on with these township village banks at the very bottom of the system. So basically, okay, once the city government, local state bank issued this receipts to the depositors who deposit money into the village township bank, they chose not to report to the central system. So that's why the central system.
So wait a minute, Adam, just 1 second. That means that the amount of deposits that at the city level that was reported actually is less than the actual amounts they had in their accounts. Because in other words, all of that money at the lower levels never entered into
the central clearing and settlement system. I think so. I think that's the right inference to make. So basically, in that sense, localities could have amassed even more deposits than what the center actually knows. So I think that's again, going back to the systematic crisis problem, the question, these are the things that Beijing can fix. Basically, we're not talking about opening up your market to foreign or private banks. These are the things that, regulatory problems that you can fix.
Right. All right, let me then take you back and try to find out, because one of the possibilities when I first read these reports about what was going on in these little township and village banks, the ones that weren't letting depositors get their money, is that somehow I was thinking that local governments or local state banks or somebody has been investing too much in the real estate sector, and that when the real estate sector collapsed, that somehow that then directly affected the amount of money that these small banks had on hand. Was that also an issue?
Yes, that's absolutely correct. Because the local state banks, so basically local governments, over the past 10, 20 years, consider there are two pillars of their local economies. One is the real estate sector. The other is the local state bank. At least in my hometown, when you talk to, average citizen on the street, basically who are the biggest pillars of our local economy? They point to the local state bank and the local real estate sector, the biggest local real estate firm. And they were deeply intertwined with each other because, the bank in my hometown and based in other places in China, they've been the major. So basically, the question is, there's been over concentration of these of lending from the local state banks on the local real estate sector. I think the data that I came across from a few years ago is that they probably I think for many local state banks, roughly 30 to 40% their lending goes to the real estate sector. And that figure is actually more than the big four. I mean, much, much higher than the big four. So
Yeah.
you're absolutely right. They rise and sink together. So that's why in the beginning of the talk, the question is, why are all these problems, occurring all at the same, festering at the same time?
Right.
Because
Right. So,
the system,
but then it
yeah,
takes me back to the question: if in fact that is the case, and and given the financial difficulty of the real estate sector, I mean, what you described as the way that the state is able to take care of problems by getting the local government forming committee, restructuring
at,
debt and
at,
such
at great cost, at a great
at
cost.
great cost. And so the question there, because if this problem is so prevalent across the country, is because essentially you're moving debt around, is the local government intervention and having local other SOEs and having
Yes,
local government
yes,
financing
yes.
vehicles doing all this? I mean, I guess the question is there enough sort of in other pockets to sort of keep this whole thing afloat? Because essentially I think that's what we're talking about, right?
Mm-hmm. That's a hard question, Gene. Is there
I
enough
know, I
to
know,
sustain this?
I don't know, I'm just trying to.
Are we getting to the point where Beijing had to do this as what they did in 1998 when they had to save the big four banks? Um, I mean, before zero COVID, they might be able to handle this, but I was talking to some um, local government officials and who are in charge of zero COVID, and also some local bankers. They are dealing with a very, very tough situation, and I think that's why I'm hoping, and we see the data, right? The drop in the number of punishments and warnings to banks. I think Beijing knows that if they are too harsh at this particular moment in time, I don't think the whole thing, the game will keep going. But yeah, I can't really answer the question. Is there enough to?
Yeah, I know. I'm sure that you can't answer that question. We have a question from the audience, so let me just turn to that rather than monopolizing you any further.
Yeah.
So, thanks you for your talk. And it says in the first half of 2019, to prepare for the tsunami from the global financial crisis, China banking loans grew around RMB 7 trillion in 6 months, probably unprecedented in world banking history. How many, I guess, what percentage would you say was booked by these local state banks?
Very good. My statistic, if I remember it correctly, in 2009 and 10, the local state banks at the city level alone, okay, so half of the money that borrowed from the local government financing, because the governments were again borrowing from the local government financing vehicles, half of their borrowing came from the city level local state banks, and the other half came from the big four. So in reality, I think local state banks could have easily covered more of the stimulus package than the big four did in many localities. So basically, they were a big part of the stimulus story. That's why we see that. Remember the graph about the rise of the branches of Baoshan Bank? They grew the fastest during the global financial crisis.
Right.
So that's the fastest. That's their period of fastest expansion. And but that was also the period where these local state banks got even further intertwined with the local government finance vehicles and the local real estate firms. So yes, the short answer is yes, they were absolutely critical in implementing the stimulus package, even back then.
Okay. Let me ask you another question, and you probably sort of won't be able to answer this, but do you see, there was considerable media reports about the fact that these depositors weren't able to take their money out from these, small banks. Do you, and there's also talk about more broadly in the economy about sort of the loss of um, confidence in China's there's sort of the real estate market and such, and that's one of the reasons why there's such a housing slump. Does this in any way affect does this also extend to these local state banks? Is there like some any signs that there are people are a little afraid to put their money into these local state banks after all of this?
Um, yes, so that's why I think in some of the cases I know, local governments have been trying to preempt this, deposit from, basically withdrawing money from these local state banks, and they've been doing all these sorts of things, trying to, in one locality that I know of, these local governments even put up signs on the streets suggesting that, such and such a bank is also a state-owned bank. So basically assuring that the depositors that they are not, that their money is guaranteed. Jean, does that answer the question to some extent?
Uh, yeah, it's a very difficult sort of question. And there's another question that came in from the audience, and that is, um, you said that you noted that there was no creative destruction, only reorganization. But what could that reorganization look like in the near to medium terms?
Yes, I think we are going to see the decrease in the number of local state banks in China because a lot of them will be merged. For example, in the Liaoning province, there used to be 14 local state banks, one for each city. But now I think 5 or 6 of them are being merged, reorganized into one bank by the provincial government, because basically the government is trying to pool resources together and to make sure that the bank that they create one bigger financial institution. so that's one way of reorganizing, like merging a lot of these local state banks, but still what will remain will still be a local state bank, because who is doing the reorganization is the local, is either the provincial government or the city government. For example, so what happened to the Baoshan Bank?
Yes, I I wanted to know that.
So it didn't. Well, it did disappear, but it reemerged right after the bank collapsed, because the Baoshan Bank has now become Mengshan Bank, because the central government, along with some big SOEs, a local fiscal bureau, they basically created another bank to replace the old Baoshan Bank. So basically, they still have to make sure that the local government has this
Right.
local state bank in place. And what happened to some of the, because Baoshan was very aggressive in expanding its national presence. So because the bank had a lot of branches outside Inner Mongolia, what happened to these branches? So these branches were taken over by, I think, another local state bank from Anhui province. I think it's probably Huishan Bank or something like that. I can't remember exactly, but I have my notes. I have to go back to the notes to see what happened exactly. But I think I can't remember why exactly Huishan Bank. There was a little bit of a political bargaining as well. You have to read my book. I can't remember it now.
That's okay, I think the point is an important one, that basically you still have the same incentives in place for local government, the same needs, and so they're just going to, as you say, keep reorganizing until some other solution. And then our time is almost running out, so let me ask the last question. Um, and that is, what role could foreign banks play in China that the central government would see as beneficial or stabilizing? In other words, what does the Chinese government really see as the main role for foreign banks in China versus state owned? Even though I know you said that you didn't think they would play a major role, but there is some role. So I'm curious what, let's sort of have your finish on that.
um, I again, I don't think they will play a stabilizing a bigger role in the Chinese financial system. But I think the government is, a lot of these local state banks actually have foreign investors in them, but they have this cap. You can't invest
Right.
over more than 20% or so. I think the government will be, or has been, I don't remember exactly, is now allowing foreign banks to hold more shares in these in Chinese banks. But will that change how these local state banks operate? Basically, will that change who makes the final say in allocative decisions? I don't think so. But one funny thing about these foreign banks is that some of them have also been trying to create the village and township banks. And in some remote places like Xinjiang, I don't know exactly what's the incentive behind that. Are they trying to please the local officials or central officials? But I can dig that into. I can dig into the details of that a little bit later in the book.
Okay, let me just, okay, there we have time for like one more. This one, I missed this question. I'm sorry. And that is basically about once they want to know if state and local banks will they start to offer more sophisticated retail offerings, i.e., fund investment, etc., in the future, so Chinese consumers can diversify beyond real estate and stock market investing, or is that seen as too risky?
I think the local state banks. By the way, I think that's a great question. I think yes. The local state banks have been the pioneers in innovating financial products in China. One thing that I didn't mention during the talk is the wealth managed products, which is a big part of shadow banking, which we didn't have time to cover. But let me just say that the local state banks are the pioneers in innovating in creating these wealth management products, not the big four. So back in as early as 2013, I think the local state banks accounted for more than 70% of the new wealth management products issued in China. But yes, risky. The problem is that a lot of Chinese, aunties and uncles believe that these products are just like deposits. And I think the banks are trying to correct that misperception. They are investments. They are not guaranteed. But I think what matters is really people's belief. If they continue to believe that, sure, you can call these products whatever, but it's from you, a state bank, local or central. I think that's a little problematic.
Right. Well,
Yeah.
our time is up, but thank you so very much for a very insightful and very useful discussion. And we look forward to seeing the book as soon as possible.
Yes.
But in any case, this is a very, very timely topic you're working on. So I hope that you'll be able to educate more and more about the importance of these local state banks. Thank you very much, Adam. Thank
Thank
you,
you, Jean. Thank
audience.
you.
Okay, bye bye. Thank you.
Bye.